So we are recording, so everybody make sure you have your cameras off and your names changed. And welcome, everyone. Welcome to what we are so blessed to have, a workshop from the Cornell Entrepreneurship Clinic, who will be helping us talk about finances for sex worker organizers, specifically thinking about creating different forms of financial entities that might be useful when we're doing this kind of organizing. And this is the last event in the Sex Workers Organizing Against Barriers Conference, which has been going on for the last 2 weeks. And I'm so grateful to have you guys with us today. So I'm just going to read our community agreements. I know that folks here who have been part of the conference and are probably pretty familiar with them, but just in case for anyone also who's watching the recording, our community agreements are adapted from the Asian American Feminist Collective. Oh, and I just switched my place on the page. I'm so sorry. Our community agreements are adapted from the Asian American Feminist Collective, Brave Space, Collective Sex, Alt-Div Hummingbirds, and By Us For Us, and are as follows. First, to bring in our histories and to speak from our own experiences. Second, to be committed to each other's collective learning and growing. Third, to be open to learning. Fourth, to respect the diversity of our identities, which particularly for the purposes of this conference includes not assuming the identities of organizers and activists for whom sharing every element of our lived experience is not always safe. Fifth, to practice not using ableist language. And sixth, to prioritize care for ourselves and each other. And this last agreement in particular is a disability justice issue, and our panelists and our audience members should feel free to do whatever is needed to care for yourselves during this conference, including standing up, moving around, lying down, or even disengaging from any of the events at any time. And I'll also add that many of our panelists are zooming in from North America or Australia throughout the conference, where we are living on stolen land that is still and always Indigenous land. To learn more about the land you're living on, if you're in the United States, you can look to the resources provided by the Native Governance Center, which are available at nativegov.org. And so with that, I would like to welcome the Financial Entrepreneurship Clinic. We're so lucky to have with us today Celia Biganis, Kayla Anderson, Cassandra Barney, and Melissa Lynn. And so I'm going to stop talking now so you guys can start your presentation. Welcome and thank you.
Thanks so much, Lorelei. We're delighted to be here with all of you. I'm sorry that this is virtual, but there are some advantages to the virtual world that we could reach out to all of you. So I'm here with a team of third-year law students, Cassandra, Kayla, and Melissa. I'll let them each introduce themselves as they speak to you. As Lorelei mentioned, we are with the Entrepreneurship Law Clinic at Cornell Law School. Our goal is to provide pro bono legal services to small businesses, entrepreneurs who don't otherwise have access to the legal services that they might need. I had the pleasure of working with Lorelei, what feels like many, many years ago when Lorelei was just a first-year law student. And we've been delighted to work with Lorelei on a variety of other issues over the past few months in our clinic. So what we're going to do today is we're going to just run through some basic issues about how you can structure your community organizing work with a few goals in mind. One is, of course, protecting yourselves in terms of both protecting your identities, if that is a concern for you, also protecting yourselves from any personal liability attached to your work. We're also going to talk about how you can best serve the individuals in need with whom you are working. Again, we're going to focus on identity protection and just making things simple and easy so that the law isn't standing in your way. We have tried our best, and Lorelei has been a great sounding board for us in trying to anticipate what your needs and questions are. But certainly we're going to leave a whole lot of time at the end. So, please feel free to toss in any questions that you have. As we're going, feel free to put your questions in the chat. I'm not sure we'll be able to address them in real time. I don't know about you guys. Maybe I'm too old, but I can't read the chat while I'm talking. But we will note them. So if we don't address them in real time, we will come back to them at the end. And then more than happy to have just a conversation, make this interactive. It's a small group and we'd love to hear from you. So one other thing I should say is we are lawyers. We dive into the detail. We're going to show some slides and there's going to be a lot on each slide, particularly at the beginning, where we're sort of just laying the foundations for what we're going to talk about. But you do not need to take it all in. We are going to be, obviously this is being recorded and we'll provide the slides to Lorelei to share with all of you as well. So don't feel like you need to pay attention to everything. I apologize for the shaking in the background. That's one of my many office dogs who is joining us for this presentation today. So without further ado, I will hand this over to our esteemed team, Kayla, Melissa, and Cassandra, and I'll start sharing the slides. Thank you very much.
All right, I'm the first presenter. My name is Kayla Anderson, as Celia mentioned, and I'm a third-year law student. So I'm going to start off by just talking through choosing a legal entity and kind of giving a broad overview of what entities are out there. So next slide. So first off, these are some considerations to take into account when you're picking. Obviously, these are going to vary by the individual. So first off, your protection of personal assets. Do you need limited liability? Things like that. Attractiveness to investors and lenders. Are you going to try to expand? Are you going to want some kind of investment? Those are things to keep in mind when you pick an entity. Ease of formation. How easy will it be to set up your entity as you move forward? Costs, startup and ongoing. So how much will it cost to initially file articles of incorporation, things such as that. In addition, are there any filing fees yearly? Tax strategies, as we note on here, non-tax factors are the primary considerations for this decision, because you can kind of choose through different business entities how you want to be treated for tax purposes, but it is something to keep in mind. And then finally, management requirements. What kind of a structure do you want? Boards of directors, members, things such as that. And then we're going to move in and we're going to kind of go through in a chart form, basically, how these apply to different legal entities. So first off, just significant characteristics of the different entities. Corporations, there are C-Corps and S-Corps, but they're pretty similar. They're owned by stockholders, managed by a board of directors, and most large businesses that you would think of are set up as corporations. And then also the principal attractions of C-Corps and S-Corps are limited liability for the owners. There's well understood governance laws, especially in states like Delaware, and then the ability to transfer ownership easily. One kind of thing to note though, depending on the type that you would choose, there could be the possibility of double taxation, meaning taxation at the corporate level and then at the individual level. Next, there's partnerships. So this is a separate entity for some purposes, but not for others. There is pass-through taxation, which means the people in the partnership will pay taxes as it's paid out. So the partnership itself as an entity doesn't have to pay tax, but then it gets taxed out to the partners based on their respective interests in the profits. So if there are two partners and it's a 50-50 split, then they would each pay personal taxes on their 50% that they would take out. And also worth noting, if you're looking at investment, a lot of venture capital and investment funds can't invest in partnerships. Then limited liability companies. So LLCs essentially attempt to combine the best attributes of corporations and partnerships. They also have that pass-through taxation status, but similar to partnerships, the venture capital funds and investment funds can't invest. So if that's something that you'd be looking for later, keep that in mind. And then there's sole proprietorships. Those are owned by one person and they really have little legal significance separate from its owner. So essentially the sole proprietorship is the individual. It is the most prevalent business form though, due to a large number of family businesses. But one of the main concerns with the sole proprietorship is that there's unlimited personal liability to the owner. So next there's benefit corps, which is a pretty new type of legal entity. So it's kind of a corporation, but it has a social purpose. So there are three goals that it pursues: generating a competitive return for the shareholders, pursuing a stated public benefit, and then promoting the best interests of those materially affected by its conduct. Next, there's nonprofits, which is an entity that pursues its stated charitable goals only, and it has to provide a public benefit. Most nonprofits are going to be set up as 501c3 organizations, which is a IRS terminology, which essentially means that they're tax exempt. Not all nonprofits will be set up this way though. And no part of a section 501c3 entity's net earnings can provide benefit to a private shareholder or an individual. And then finally, there's fiscal sponsorships. So it's not actually a legal entity per se. So essentially what happens in a fiscal sponsorship is there's a 501c3 organization that acts as the fiscal sponsor, and they sponsor another entity or individual, which is the project, and that entity or individual will further the nonprofit mission of the 501c3 organization. So in these type of arrangements, the fiscal sponsor will provide the project with 501c3 benefits like tax exempt status and tax deductions for donors. Additionally, the fiscal sponsor will assume legal responsibilities for the activities of the project. And there are different models, Model A and Model C, which depends on the maturity of the project, as well as the relationship between the fiscal sponsor and the project. So now diving into that table I mentioned, we're just going to kind of go over those considerations I noted at the beginning and how they apply in each entity type. So for C Corps, S Corps, and LLCs, all three have limited liability. Regarding ease of formation, C Corps and S Corps are really similar on this front. So you have to file a certificate of incorporation with the state. You also have to have basic corporate governance documents like bylaws, things like that. And in particular, if you were to establish in Delaware, there are really well-established procedures. They streamline the process, and it's incredibly straightforward and fast if Delaware would be an option for you. Management-wise, C Corps and S Corps are also very similar. So they're managed by directors and officers, and then the directors will owe fiduciary duties of care and loyalty to the business. And then on tax treatment, this is where C Corps and S Corps will differ. So for C Corps, as noted, corporate profits are subject to double taxation, which essentially means the corporation itself will pay income tax, which is currently at a 21% tax rate. And then the shareholders will pay personal income tax on any dividends that are paid out. So there's this double taxation. Whereas in an S Corp, as well as an LLC, there's that pass-through tax status. But the one thing to note on the S Corp front is that to have this pass-through tax status, the corporation has to file with the IRS to elect that. And then with LLCs, regarding the ease of formation, you file a certificate of formation with the state. The documentation on this front is a lot more flexible than a C Corp. But one big thing to note regarding LLCs, if you're operating in New York, is that LLCs have to publish a notice of formation in 2 newspapers for 6 weeks, which is a pretty heavy requirement that you'd have to ensure that you do if you choose to establish an LLC in New York. And then management-wise, LLCs are managed either by the members or by a designated manager. And they can have a board of directors if they want to, but it's not a requirement. As noted previously, LLCs are pass-through tax entities, meaning that the entity itself doesn't pay taxes, but the profits and losses are then passed through to the LLC owners, and they account for those profits and losses on their personal income tax returns. So now general partnerships, limited partnerships, and sole proprietorships. For general partnerships, there's unlimited personal liability. It's just split amongst the partners. Ease of formation, you just file a certificate of formation with the state. There's no publication requirements. You do need to have a basic partnership agreement though. Management, it's just managed by all the general partners. And then for tax treatment, it's pass-through taxation as well. Limited partnership, so there's limited liability, but it's only for the limited partners. And to be considered a limited partner, you have to essentially act as an investor. You really can't do day-to-day functions. If you do, then you won't be considered a limited partner anymore. But limited partnerships have to have a general partner, and they bear unlimited personal liability. So for forming them, you just file a certificate of formation with the state. A limited partnership is similar to an LLC in New York, meaning that there is that publication requirement. And additionally, you have to have a basic partnership agreement in place. Regarding management, the general partners assume the liability and handle the operations of the day-to-day, like running of the business. And then the limited partners, as I stated, are really just investors. They really can't have authority over the business. Otherwise, they will lose the limited liability status. And then when it comes to tax treatment, again, it's pass-through taxation. For sole proprietorships, again, there's unlimited personal liability. Regarding ease of formation, these are really the easiest to form because there's no registration required if you're going to use your own personal name. It has to be your own legal name. And then really as soon as you start a business, you have a sole proprietorship, but it's worth noting that if you need a DBA or you have to have a DBA if you're going to use any other name. And so you'd have to file that with the state and that would be a public filing. Regarding management, you can't bring on partners and you can't pass the business along. And then again, with tax treatment, business income is just taxed as your personal income because essentially you and the entity are really much like the same. Oh, and I just noticed the comment from Lorelei. DBA means doing business as, and it's essentially a form that you have to file if you're going to do business under a different name than your legal name in a sole proprietorship. And then lastly, the benefit corp, nonprofit, and fiscal sponsorship. Benefit corps, again, have limited liability. For forming, there's a formal registration process that's really similar to the traditional corporations mentioned previously. But you do have to have a statement of your social or environmental purpose to be considered a benefit corp. Management is owned by the shareholders and they're entitled to profit distributions, annual reports, voting rights. But the shareholders don't exercise any day-to-day oversight. That oversight is done by management, and then management is also overseen by a board of directors. For tax treatment, a benefit corp is not tax exempt, so it's taxed as either an S corp or a C corp, depending on what election is made. And then for nonprofit 501c3 organizations, again, there's limited liability. Formation is really the difficult part in the 501c3 sphere. It's a pretty intensive process. So there's a detailed application that you have to file with the IRS, and that review of that can take a few months. And then once the IRS approves the application, you also have to be registered as a charity in the state or states of operation. And then there's yearly filing requirements as well. For management, most nonprofits don't have any owners and they're just completely run by a board of directors. There is another option, which is where you can have members and they're entitled to vote on major decisions, but the members can't have any kind of financial stake in the business. And then on the tax treatment, as stated before, they're exempt from federal income taxes. Regarding state tax exemptions, it varies. Some states have you file a separate application. Other states just follow the federal status and you're tax exempt by being tax exempt federally. And then finally, for fiscal sponsorships, again, there's limited liability because you're under that 501c3 organization. So it can be a shortcut for the project to obtain 501c3 benefits in the meantime, meaning if you're looking to file for that 501c3 status, it can take a few months. So fiscal sponsorship might be something to enter into in the meantime so that you have that tax exempt status and your donors have that tax deduction. Management, it depends really on the agreed upon relationship between the fiscal sponsor and the project. There are different models depending on the maturity of the project, as well as the relationship between the fiscal sponsor and the project. So really when it comes to how they're set up, it's just a negotiation between the fiscal sponsor and the project about what works best for each party. And then regarding donations, any donations to the project actually have to be directed to the fiscal sponsor and it goes through them. And that's the only way to receive the tax deduction. And then regarding tax treatment, again, the project benefits from the fiscal sponsor's federal tax exempt status. And now I will pass it over to Cassandra to get into privacy implications.
Yeah, so we're going to talk a little bit more about what the privacy implications of these different entities are. More specifically, we're going to look at what information are you going to have to file with the state and what is not publicly accessible from any member in the public. So first, kind of corporations generally, Kayla mentioned, we have the C Corps, S Corps, B Corps. They're all going to kind of fall under the same umbrella when talking about privacy. So in Delaware, there's no personally identifiable information available online on the certificate of incorporation, as long as you use a third party for a couple of things on the certificate of incorporation. The first would be using a third party business for your registered agent. So typically you have to have, if someone's going to serve process on you, For example, if someone might be suing you and they need to find you and serve process, you can outsource this and have a business act as your registered agent. So they're going to put their address, service of process would go to their address, and then they would contact you personally. So it kind of adds an additional level of privacy protection. So you don't have to put your personal address there for everyone to be able to contact you. And then the second would be, there's always going to be an incorporator who incorporates a particular business. They're usually an individual who, on behalf of the corporation and the directors, is going to file all these documents. They don't really need to play any part in the business. Their only function can really just be to file the incorporation documents. Then they're going to appoint and name the initial directors, and they can be completely out of the business. So we usually recommend making sure to have a registered agent, something like Harvard Business Services, so they put their address out there instead of yours, and then maybe having a separate individual do the incorporation filing. So they're going to be separate from the business. If they're not planning on being involved, they can put their name down and then kind of step away. Now, in addition to the certificate of incorporation, which sets up the business, every year there's also franchise taxes and an annual report that needs to be filed with the state. And portions of the annual report, including things like the names and addresses of the directors and officers, are obtainable in hard copy for a fee. So it's not easily accessible in that someone can't just hop on the internet, go to the Secretary of State's website, put in your company's name and find this information. They would really have to be trying to access it. They'd have to pay a fee. They would have to wait for it to come into the mail. So it's not necessarily very easy, but it is possible for someone from the public to access some of this information. So if that's really important for you to keep private, a corporation might not be the best option, but it's kind of what you're comfortable with. In New York, it's very similar. Again, you can use a third party to be your registered agent for the certificate of incorporation, and again, using a different individual to be the incorporator. And they're going to have, instead of annual reports, biennial reports or biennial statements, which is once every 2 years. And these statements are also part of public record. And you can get somewhat creative to protect your privacy, again, using the registered agent to be listed. But things, for example, like the CEO need to be listed on the biennial statement. So if you have someone who is in the business working with you who might be a bit more comfortable with having their name disclosed, they might be the person you want to have as chief executive officer, because their name is going to be listed on the biennial statement. So just kind of keeping these sorts of things in mind when you're looking at what is going to be part of public record, what's going to be accessible and what's not. So again, these items can be obtainable, but it's going to be a little bit more difficult for someone to get it because they're going to have to pay the fee and wait for the actual hard copy to come in. Another option is a limited liability company. So if you do form it in Delaware or New Mexico or Wyoming, those are what are known as anonymous LLC states. So this means that they're just a regular LLC in a state that doesn't require you to disclose the managers or members, which can add a good level of privacy. So it can prevent others from accessing your information or harassing you. Legally, there's really no difference between that and a regular LLC. So you still get some of the benefits like the tax advantages, limited liability, some flexibility in how you manage it. You can also, if you want to keep, your personal name separate from the business, not have necessarily that association. If there's any negative fallout with the business, that might be one benefit if you use an anonymous LLC, and then help to avoid frivolous lawsuits. So someone can't just type in your name, find that you own this company, and then try to bring a lawsuit against you because they know that you have these particular assets. Some other considerations to keep in mind, though, is that even though this is an option, it still doesn't guarantee that they're going to protect the members' privacy or their managing members' privacy. Also, it's not going to guarantee anonymity from your bank or the IRS. You're still going to need an EIN to pay taxes, to reveal some personally identifiable information to the bank. And if it is used improperly, even anonymous LLCs can still have the corporate veil published. And so piercing the corporate veil means if, for example, you're commingling funds between your personal assets and the business assets, you're not really keeping those two entities separate. You could potentially be personally liable if someone is suing the company and all of that is commingled. So just keeping in mind if you're going to have an LLC, to still keep the entity completely separate, even if you think you're anonymous. And then in Delaware, some ownership information is still going to be disclosed directly to the state, but it's not going to be published. And then the business, of course, can still be subject to lawsuits. If someone does serve a subpoena and it's filed through an attorney, your identity could still be disclosed to the party that's bringing suit. So some things to keep in mind with the LLC. One thing to note too is that even if you create an anonymous LLC in Delaware, if you're choosing to operate in a different state, let's say you wanted to create the LLC in Delaware, but you're planning on operating in New York, for example, you can do that, but you're going to have to get authorization to operate in New York, which we'll kind of briefly discuss the costs and the process of that a little bit later. But you're still going to also have to comply with the requirements for an LLC in New York, which would include things like the biennial statement and the publication requirement that Kayla was talking about before. So you still don't technically get away from all of the requirements. It is state by state specific. So we recommend looking more in detail to what your state requires. But if you are setting up an LLC in Delaware and in New York, keep in mind that some of the information that you thought would originally be private might actually end up going on public record. We also have nonprofits. These are really not very private at all if that's something that is important to you. Really a big thing with nonprofits, because they're supposed to be for a greater purpose, is transparency. It's a big part of nonprofits. Typically, the application is going to include the founders' names and their mailing addresses. You're going to have those ongoing reports and the initial registration, and all of this is going to be part of public record. Another big thing is going to be tax filings, which need to be made available for public inspection. They're going to have to be filed with the IRS each year on Form 990. And this can have a lot of information, like the names and addresses of the personal officers. And so you just want to be, again, cognizant of the information that's going to be circulating out there. And with nonprofits, it's going to be more information rather than less. So if privacy is really important to you, nonprofit might not always be the best option. And then lastly, we have the Model A fiscal sponsorships and Model C fiscal sponsorships. Model A is going to be if you have not set up like a separate entity form. So you're going to be operating completely within the sponsor. So typically, this can provide some protection, but if you are bringing in donations, for example, that end up being a significant part of the sponsor's activities, they might need to report it. And so you might end up having your individual name or your project's name listed on the Form 990. So it's not going to be necessarily entirely private, even though there might be kind of one extra shield of protection. And then with Model C fiscal sponsorships, that's when you have your own legal entity set up. So for example, you might have your own S-Corp set up and you're making your own tax filings, but you're still benefiting from the sponsor's tax exempt status. So some of your identity disclosure, again, could happen through those corporate filings that we discussed earlier, because your entity is going to have some things that are going to be on public record, either with the state of Delaware or New York or wherever you're incorporating. Next is sole proprietorship. So this is really if you're just kind of operating as an individual, right? So there's really not that much protection. Either you're using your own legal name, or like Kayla was mentioning, you're using a DBA, doing business as, which if you are using a DBA, it can still be traced back to the sole proprietor. So it's really not going to offer great protection at all. And then you're going to have to register that DBA in every county that you're operating in. And we'll go over that a little bit more when we discuss costs. And then with partnerships, corporate filings with the names of the partners are usually not public record, but can be obtained upon request and payment of a fee. So again, it's a similar thing where anything you're going to file with the state and any of that information is not going to be readily accessible on the internet. It's not part of some database, but if someone is willing to pay a fee and actively ask the state for this information, typically they're going to be able to obtain it. So just kind of to give you a very general summary, most of this is based off of Delaware, setting up corporations, LLCs, nonprofits, et cetera, in Delaware. So items that are going to be filed with the state for corporations, again, includes the things like certificate of incorporation, annual reports, franchise taxes. Those things that are highlighted in green are going to be things that can be obtained by a member of the public, although again, not necessarily easily obtained by that member, but it's possible for them to. And things in red are going to be things that are going to be kept private. So things like your bylaws or corporate governance documents, the incorporator statement, which is, again, when the incorporator kind of appoints those initial directors and relinquishes controls and steps aside, all those things are not going to be filed with the state. So they're going to be kept relatively private, but anything like that certificate of incorporation or annual reports and all that information can technically be obtainable from a member of the public. With the LLC, very similarly, certificate of formation, if you are setting up in Delaware, but then you are operating in New York, things like the biennial statement is also going to be accessible publicly. Reason we put things like taxes generally in red, even though they're filed with the state or with the federal government, is the IRS is really going to keep that information private unless you're a nonprofit. So that's not something to necessarily be concerned about, because the IRS really acts kind of like as a vault with that information that you give them. So LLC, again, like things like your operating agreement and how you're going to conduct your business internally is not going to be filed with the state, so it's going to be kept private. Nonprofits, on the other hand, really have a lot of information that's not only filed with the government, but that's just readily accessible and available for public inspection. Things like the certificate of incorporation, annual reports like the other ones, but also like their form 1023 and tax form 990 and your annual tax form. So again, there's a lot of information that's going to be publicly available if you set up as a nonprofit. So as far as like the spectrum of identity protection, sole proprietorship is probably the least protected form. Most of the time when someone is operating as a sole proprietorship, you're going to be using your legal name. So it's really just going to be out there. It's going to be you. And again, DBA, it's pretty easy to trace back who is operating under that DBA. 501c3 is also another one that's going to be kind of required to be allowing the public to inspect a lot of their documents and tax forms and things like that. Then kind of moving forward, Model A fiscal sponsorship adds kind of a little bit of a layer of protection. But again, you're going to see that it's pretty easy to peel back that layer, especially if you're operating under the 501c3 and your project is for your individual name, it's going to be listed on that form 990, assuming you're bringing in enough revenue to trigger that. Corporations, partnerships, Model Cs, they're all going to provide some protection, but just know people can technically obtain it from the public. They're just going to have to pay that fee and really be actively looking for that information. And then anonymous LLC, as long as you're not operating in another state that's going to require additional disclosure, can be a really good option if you are really looking to emphasize privacy. And then one quick note is just as far as like public disclosure implications, sole proprietorship is really going to be the only structure that's going to require you on a form W-9 to put the individual's name. All other types of forms like the S Corp, LLC, C Corp are going to have you put the entity's name on the W-9 if you're providing services to another company, as opposed to anybody or any particular individual's name. And then this one doesn't have really as much to do with public disclosure, but has to do with exchange of information between private parties. So generally, if you're making a payment to an individual of $600 or more, it's going to require that you complete a form 1099. And they're not made public, but they do require, the payee to give some identifying information to the person who's going to be paying them. So that includes name and social security number. Payment is exempt from the 1099 if you are fulfilling a need. So the example we have here is if you're going to have a bus pass for a low income individual to commute, or you're paying the rent directly to a landlord. So these can be interpreted as serving a need, but it's really going to be challenging for a for-profit entity as opposed to a nonprofit entity to be justifying these payments to individuals as meeting a need. So just something to keep in mind, again, with exchange of information between people and the business and individuals, as opposed to just what's publicly disclosed. And now we're just going to quickly discuss cost. We're not going to go into too much detail, but just kind of give you a ballpark of what the cost ranges are going to look like for these different forms. So for a C or S corporation, you're going to have that incorporation fee of $125. There's no publication requirement like there is for the LLC, so there's no cost associated with that. And then typically there's going to be franchise taxes, which in New York is going to be about $25 a year, assuming you're pulling in less than 100K per year. And then if you're going to be an S Corp, just know that you're going to have to make sure you make that federal election and that state election in order to be taxed with the pass-through taxation. For limited liability companies, there's a filing fee of $200. And then probably what's really a barrier to a lot of people being able to utilize this particular entity form is that notice of formation publication requirement. So typically you're going to be required to make this publication for 6 successive weeks in 2 newspapers in the county in which your entity is going to be located. One's going to be printed daily, the other weekly, and the newspapers you don't necessarily get to choose. They're going to be designated by the county clerk. Costs can range from $80 to $1,000. Sometimes you hear upwards of $1,500. So it can be really expensive and a barrier for some people to set up a limited liability company, kind of depending on what county they're in. And then there's also going to be that file a certificate of publication, which is going to be an additional $50 fee. As far as franchise taxes, they're going to be a pass-through entity, so it's really not applicable for LLCs. For sole proprietorships, no filing costs, really you just operating as an individual. Again, no publication costs. The only cost kind of related with the state is if you decide to do a DBA. And so if you are going to be, again, in New York specifically, the DBA will be $25 for each county that you're operating in outside of New York City, and $100 for each county within New York City. Something to keep in mind, again, even if you're not operating in New York, keep in mind what your state's costs might be related to DBAs. Then we have B corporation, certificate of incorporation, again, around $125. Publication costs, there's not going to be any state franchise taxes are not going to be applicable. For nonprofits, their certificate of incorporation is going to be around $75. They are tax exempt entities, so they are exempt from corporate and franchise taxes. Fiscal sponsorships, no filing costs, no publication costs, and typically no state franchise taxes, particularly if you're operating as a Model A. So you're going to be that means you're completely housed within that sponsor. You're not your own separate legal entity. The only fee that might be associated is the fees paid to a fiscal sponsor. Typically, in most contracts, those are going to be between 4 to 12% of the annual revenue, but it's going to be negotiated in the contract. It really just depends on the relationship between the sponsor and the one that they're sponsoring. And so this just kind of gives you an idea of Delaware. So all the previous, the slides we were talking about costs were about New York. So Delaware is somewhat similar, but the costs just, range a little bit differently. Formation fee is going to be about $89. And then you might, if you're creating an entity in Delaware, which you completely can do, even if you are deciding to operate in New York, you just have to remember that you're going to have to get that authorization to do business in New York. So $225 to file that application, and you're also going to have the certificate of status that you're a Delaware corporation, which is $50. And then they're also going to have franchise state taxes, which is going to kind of vary on how you've decided to set up your shares. Limited liability companies, In Delaware, it's just the $90 formation fee. If you're just going to be operating in Delaware or in a state that doesn't require the publication requirement, then you would not have the publication costs. But again, if you're an LLC operating in New York, you're still going to have to comply with that publication requirement, which can range anywhere from $80 to like $1,500. And then in order to register to do business in New York and have that authorization, it's $250 to file that application. And then state franchise taxes are kept at a fixed price of $300 per year. So proprietorship, again, not really applicable for these for that particular entity type. But if you're going to be doing the DBA, just know that it's going to be the $25 for any county outside of New York City, and then $100 for any county within New York City. Then for B Corporation, $89 for that certificate of incorporation. Again, all of these are going to be very, very similar. Same thing for the nonprofit. It's going to follow a similar pattern as New York, just the prices are slightly different. And then again, same thing for fiscal sponsorship. So that's pretty much follows the same pattern as it did for New York. And so I'm going to pass it along to Melissa, who's going to talk about some key takeaways to kind of finish up the presentation.
Hi, everyone. My name is Melissa. I am also a third-year law student, and this is my first semester with the Entrepreneurship Law Clinic. We are so excited to be here, so thank you for joining and thank you for having us. Wow, okay, so that was obviously a lot of information. Like everybody's mentioned before, we will send out these slides if you want to dive into the particulars. Obviously, you'll see that there's a little bit of a slant towards the New York and Delaware law. We are speaking about these entities more generally, and we kind of encourage that if you are located or doing business in one of the states outside of these two, that you take a look at your state-specific jurisdictions and rules. So, okay, this is the last section here in our presentation. We are talking just about we're just trying to boil down a lot of that information to its bare minimum. So, okay, let's get into it. So we're starting with the corporate forms, right? The C Corps and the S Corps, and then the LLCs. Generally with a C Corp, and you'll see actually across the board here, we've got limited liability. So we love to see that. So for C Corps, it's kind of easier for capital raising if you're looking for outside investors. There's lots of well-established governance procedures, especially in a state like Delaware, and there's a lower corporate tax rate. However, the issues here are that it's less private, especially in a state like Delaware, where information can be accessed if somebody's really intent on kind of digging into the information. C Corps are subject to double taxation, and there's just quite a bit of paperwork involved, as opposed to, say, a sole proprietorship or a partnership. Okay, and then we've got S Corps, which we've seen are actually somewhat similar to C Corps. Again, we've got the limited liability, but the really great pro here is that we've got flow through taxation. So there's only one level of taxation. But then we've got a lot of other pros, similar to corporations. We've got lots of governance procedures. It also can easily convert to a C Corp at a different point in time, which is a separate procedure, but it's pretty seamless. And again, it's great for capital raising and attracting investors. Now, the cons here with the S Corp is that it's taxed on profits, even if some of it isn't distributed. So you may be paying taxes on profits that you don't actually receive in your bank account. There's a higher tax rate here. It's also slightly less private, and there are limitations on ownership. So I don't know if we got into this earlier in the presentation, but basically the main ownership limitations are that the owners have to be US citizens, and also there have to be less than 100 shareholders. So this may or may not be an issue for you, but that's just something to flag as you make your decisions. And then lastly, on this slide, we've got LLCs, again, that limited liability, the flow through taxation, lots of flexibility with management. And then we've got anonymous LLC options in those 3 states that we mentioned previously. And the cons here are we've got self-employment tax. In New York State, for whatever reason, New York State's LLC laws are super antiquated. So it can be really expensive and cumbersome to get them set up properly. A lot of people get them set up and then they forget about the publication requirement and having to do that. And the LLCs, it is sometimes harder to grow and to attract investors. So here we're touching on general partnerships, limited partnerships, and sole proprietorships. Again, these are not for-profit entities. The pros for the general partnership are that they're super easy to form and they've got flow through taxation. But the huge con for us here is that it's unlimited personal liability for all the general partners, so for everybody involved. It can be really difficult to dissolve when the time comes and can be hard to grow and attract investors. So honestly, generally, we're including this information, but we generally tend not to recommend partnerships or even sole proprietorships for these reasons. Okay, so we've got limited partnerships. We've again got the flow through taxation. The interesting thing that we talked about previously with the limited partnerships are that the limited partnerships always have at least one general partner who who assumes unlimited personal liability, but the limited partners themselves can enjoy the limited liability. So we've got someone who can benefit and another person who assumes a lot of that liability. So depending on how you want to set it up, that's just something to know. And then with the sole proprietorships, they're really easy to form. At least in New York and Delaware, you pretty much just start doing business and you've formed your sole proprietorship. We don't really have lots of registrations, filings, things like that. There's no corporate taxation and it's just less paperwork. Again, though, we've got that unlimited personal liability. It's hard to grow and attract investors and there's no ongoing business life. So again, we'll get to this, but generally we don't really recommend forming partnerships and sole proprietorships. All right, so then we're looking at the B Corps, nonprofits, and fiscal sponsorships. B Corps are just kind of a funny beast. They're a newer entity type. I know we talked about this, but they kind of have that dual purpose where they're still a corporation and they are trying to drive profits, but they also are trying to further social purposes. And so we'll see this in companies like Patagonia or like Allbirds. And so the pros here are that the purposes are multifold. It's not just focusing on profit. And we also have limited liability. The issues with B Corps, though, are that there are greater governance requirements and it's subject to double taxation because it's not technically a not-for-profit entity. And they're also, again, because they're a newer form, they're not necessarily available in every single state. So we recommend looking at your state-specific jurisdiction for the applicable rules here. And they are also slightly less private. Okay, so then let's look at nonprofits and fiscal sponsorships for nonprofit entities. So for nonprofits, these are awesome, right? We've heard so much about the 501c3s. They're tax exempt, limited liability. Of course, there's lots of fulfillment. You're working towards something beneficial for society. The cons here are that it can be really onerous. So it's kind of complicated, pretty expensive to form, a lot of governance requirements, and they're less private and they kind of tend to emphasize transparency. So that might not serve your privacy needs as much. And then lastly, we've got the fiscal sponsorship, and under a Model A fiscal sponsorship where you haven't formed a legal entity, it can actually offer greater privacy. And the project enjoys administrative support from the sponsor, especially when it comes to staying tax compliant. And then, of course, this is like one of the biggest draws. The project benefits from the sponsor's tax exempt status without having to attain it themselves. The difficulties, though, with the fiscal sponsors is that it can be difficult to find the right fiscal sponsor in terms of fit and just, a sponsor willing to undertake the project. The project has to cede a little bit of control also to the sponsor, and there's a risk of funds here. Next slide, please. Okay, so if we really had to boil it absolutely down, again, this is our general advice, but it is subject to your unique situations, your unique priorities, where you're from, where you're doing business. So this is generally what we recommend. If it's a for-profit entity, we typically recommend an S Corp or a C Corp, and more often than not, it's an S Corp that we recommend. As discussed previously, the biggest con with the S Corp is the ownership restriction. So this really is, like I was saying, the owners have to be US citizens. Have to be less than 100 shareholders, but there are tons of pros here. Limited liability, streamlined formation, got that pass-through taxation. It's pretty inexpensive and it's pretty private. And similarly, that we like to recommend a C Corp. The con here for the C Corps are that double taxation. But the pros again are limited liability, streamlined formation, pretty inexpensive. All the governance procedures are pretty laid out, and it's relatively private. Okay, and then we're just moving into our nonprofit entities. Here we typically recommend the 501c3 or the fiscal sponsorship, with maybe more of a bias towards the fiscal sponsorship. With the 501c3s, the tough part about these is that they're super onerous to obtain that coveted 501c3 status. And also they're not really great in terms of privacy because they emphasize transparency. And there's a lot of public filing requirements, and they're pretty highly regulated. But of course, the pros here are the tax exempt status, and you would be an independent entity with more control over your operations and fundraising and all those things. The other side of the coin, we've got fiscal sponsorships. Again, the cons here are that you have to actually identify and find and negotiate with a sponsor, and you're giving them some control. But with that, the good thing about fiscal sponsorships is that it's low cost. It can offer more privacy, and basically you would attain, you get that tax exempt status, you would benefit from that without actually doing any of the 501c3 filings. And the sponsor would basically help with the administrative support and tax compliance and things like that. And so when it comes to fiscal sponsorships, just a few tips on the right here, just some very practical day-to-day things. Best practices here: don't provide specific addresses, ask donors to redact your name. So a lot of times actually within a fiscal sponsorship, the donors are writing the check, they're sending it over to the fiscal sponsor and not the project, but it would be nice if they could say it's for this project without actually specifying your personal name. When it comes to receipts, use approximate mileage and not necessarily exact mileage. And just something to note, I know we talked about this previously, but the IRS is a vault when it comes to information. It safeguards your disclosures, even intra-government agency. Inter-government agency, it still protects it. All right, so we are on our last slide today. These again are just overall general best practices and final tips. Form an entity. I think you're all here for that reason. So I think that you already know to do so, which is great. Again, we typically recommend what we just talked about. And the second point here is really important. And again, you probably have some familiarity, but when we're in law school and in the legal profession, we always talk about kind of respecting the separation of the legal entity and the individual. And this is really because we, as an individual, as an entrepreneur, you basically don't want to necessarily be on the hook for business liabilities if you don't have to be. So a few things that you can do, more practically speaking, are just maintain a separate corporate bank account. If you create a corporation, have the bylaws, the officers, directors, it's okay if it's just you named for everything. If you're forming an LLC, always have an operating agreement and a manager. Don't commingle funds. This is a really big one. Don't mix your personal funds with the entity funds. Always keep them separate formally in different accounts. And then lastly, and this might seem like a minor point, but just something to keep in mind, always sign your contracts in the entity's name and not in your own name, once it's formed, of course. And that is it. We are now going to open the session up to Q&A. Thank you for listening to us.
All right, thanks so much, team.
And I just want to make sure that we stop the recording. Oh, and look at I changed my outfit. Now I'm like not cute anymore, but Rachel.